Welcome back to the deep dive. Today we're tackling a topic that, well, it can sound a bit dry on the surface.
That's putting it mildly.
Right, internal controls. But we're going to frame it as what it really is. This hidden, multi-layered defense system that's, it's protecting everything from huge public companies all the way down to your own investments. If you just think of accounting as, adding up numbers, you're missing this entire invisible infrastructure that's designed to make sure those numbers are real, that they're complete and reliable.
Absolutely.
So we cracked open the stack of sources to really understand the structure. Our mission today is to demystify this idea of reasonable assurance by breaking down the actual tactical steps companies take and then looking at the huge external hammer that is Sarbanes-Oxley.
And that concept, reasonable assurance, that's exactly where we have to start. Because an internal control system at its core is a set of policies and procedures designed to provide just that. Reasonable, not absolute assurance.
So it's not a guarantee. It can't stop every single mistake or, theft.
No, but it's the gold standard. Yeah. It's the highest level of confidence we can realistically ask for. And it's designed to achieve 5 core objectives at the same time. You can think of them as these 5 pillars of integrity.
Okay, let's hear them.
First, accurate and reliable accounting records, the big one. Second, physically safeguarding the assets.
The locks on the doors.
Locks on the doors, yeah. Third is operational efficiency. Fourth, making sure employees are actually adhering to management's policies. And then finally, of course, compliance with all the laws and regulations.
And if any one of those pillars crumbles, the whole financial picture gets a little shaky.
It becomes suspect, exactly.
Okay, so let's unpack that first big pillar, the internal one. The sources start with this foundation they call the control environment. Or, I love this phrase, the tone at the top.
Yes. And it might sound a little abstract, fluffy even.
Right.
But it's the absolute prerequisite for everything else. It's the culture. It's the belief system of the entire organization, and it comes directly from senior management and the board. If they prioritize hitting numbers over, say, ethical values,
then no amount of paperwork is going to matter.
Exactly. No number of security cameras will save them from themselves. A key part of this is the organizational structure. You have to have clear lines of authority. But the really critical check on management power is the audit committee.
Okay, so this is a subset of the board, but what gives it teeth? What makes it such a powerful check, practically speaking?
It's the composition and its mandate. It has to be made up entirely of independent, outside directors.
So they can't be part of the management team they're supposed to be watching.
Precisely. And they have to be financially literate. Their one job is to hire, compensate, and oversee the external auditors.
Ah, so the auditors don't report to the CEO.
They report to a group that is structurally insulated from the CEO and CFO. Their allegiance is to the shareholders, not to the management team that could, pressure them to look the other way.
That makes perfect sense. So once that tone, that culture is set, then we get into the actual tactics, the control activities, and these fall into 2 big buckets, right?
That's right. You have the proactive and the reactive. We call them preventative controls, which are like defenses designed to stop problems before they even happen.
And detective controls.
The alarms and cameras. They're designed to find any problems that manage to slip through those fences. You need both.
All right, this is where it gets really interesting, moving from the concepts to the specific actions. 5 core activities. Let's start with number 1, which the sources highlight as, well, maybe the most effective, but also the most expensive. Segregation of duties.
Segregation of duties is, I'd say, the cornerstone of preventative controls against internal theft. The principle is incredibly simple. You separate the 3 key functions in any transaction.
And those are
Authorization, which is deciding to do it, record keeping, the accounting for it, and custody, which is physically holding the asset.
So the person who approves buying the new computers can't also be the one who writes the check or the one who adds them to the asset ledger.
You've got it. If one person can do all 3, they could authorize a fake purchase, steal the money, and then just delete the transaction from the records.
It forces collusion.
It forces collusion, which dramatically raises the risk for anyone thinking about it. And the reason it's expensive is pretty obvious for, say, a small business. They might not have enough people to assign 3 different employees to these roles.
Yeah, that's a real-world problem. Okay, number 2, proper authorization. This feels like the check on power, not just temptation.
It is. It's about creating a clear hierarchy. A clerk might be authorized to approve a $50 expense report.
Sure.
But only a vice president can sign a contract over, say, $100,000. And only the board of directors can approve something massive like a merger. The right person has to sign off.
Control number 3 is physical controls. And my mind immediately goes to, a big vault with cash in it. But so much is digital now. How does
Okay.
that definition change?
That's a crucial point. Yes, you still have locked warehouses for inventory and vaults for securities. But the concept has totally expanded into the digital realm.
Firewalls, server security.
All of it. Firewalls, detailed access logs, and this big one redundant, geographically separated backups of all your critical financial data. The principle's the same. You're protecting the asset, whether that asset is a pile of lumber or a stream of data.
Okay, now we're shifting. We're moving to the detective side of things, finding the problems that slip through. Number 4, adequate documents and records. The paper trail.
This is the absolute backbone of any audit trail. You have the documents, which are your inputs, purchase orders, invoices, and so on.
Right.
For these to be reliable, they have to be clear, and most importantly, they must be pre-numbered.
And that's not just for tidiness, is it?
Not at all. It's about completeness. If you're going through your files and you notice you're missing invoice number 457, you immediately know something's wrong. It forces an investigation.
It turns a simple piece of paper into a self-checking alarm system.
It does. And then the records, the general ledger itself, have to be secure and protected from any unauthorized changes.
Okay, and that brings us to number 5, independent checks. And this is where we found one of the most, I have to say, surprising controls, the mandatory vacation.
It's a fantastic example. The principle is that the person doing the work should never be the only person verifying it. So that includes things like bank reconciliations or a supervisor reviewing expense reports.
Standard stuff.
But the mandatory vacation or even job rotation is such an elegant defense against a concealed fraud. See, fraud takes effort. It requires constant maintenance and cover-up by the person doing it.
So you're saying if you force that person to go away for a week.
You force someone else to step in and do their job. And if the first employee was, say, manipulating records or hiding theft, the temp is almost guaranteed to stumble across a discrepancy. It's designed to uncover the method of the cover-up itself.
That is clever. I think the real power here is seeing how these 5 controls don't just exist on their own. They stack up. They create that layered defense. Can you walk us through a really common process, maybe like buying inventory, and show how they work together?
Of course. Let's follow a widget from the moment we decide to order it to the moment we pay for it. So, step 1, we decide to buy. That's proper authorization. A manager has to issue a pre-numbered purchase order. So right there, 2 controls are triggered.
Authorization and an adequate document.
Exactly. Okay, next, the truck with our widgets arrives at the loading dock.
Now what?
Now segregation of duties kicks in. A receiving clerk, who has custody of the goods, accepts them and prepares a receiving report. But crucially, that clerk has no ability to authorize payment and can't touch the accounting records.
Okay, the goods are in the building.
And they immediately go to a locked warehouse. That's your physical control layer, protecting the new asset. At the same time, the accounting department gets the purchase order, the receiving report, and the vendor's invoice, and they enter the liability into their secure records.
So all the preventative layers are in place. What's the final safety net?
The independent check. Periodically, an internal auditor, or even just a supervisor, will take a sample of payments that went out. And for every single one, they'll verify that the full paperwork package is there.
The purchase order, the receiving report, and the invoice.
All 3. If any one of those is missing or looks off, the control system flags it immediately for investigation.
That is a very robust system when it's followed. But, history shows us, especially in the early 2000s, that internal systems can fail when there's enough pressure from the top.
They get circumvented. When executives care more about the short-term stock price than the truth, controls get overridden.
So what happens then? When the fraud gets past all those internal layers, that's where the external regulatory hammer comes down. Sarbanes-Oxley, SOX.
SOX was a direct response to those massive frauds Enron, WorldCom. It was a fundamental restructuring of corporate accountability. And what's interesting is that even though it's an external law, its primary goal was forcing companies to strengthen their internal controls.
It was about restoring trust.
Completely. And it did that by imposing some very serious consequences. One of the first things it did was create the PCAOB, the Public Company Accounting Oversight Board.
Which polices the auditors themselves.
Yes. Auditors were no longer a self-regulating profession.
Yeah.
But the element that really put the fear into the C-suite
Was the personal liability.
Absolutely. The CEO and CFO certification It's the crown jewel of SOX. Management now has to personally sign off on the fairness and accuracy of the financials.
So it's not just the corporation on the hook anymore, it's them.
It's them. If fraud is found later, they face massive personal fines, potential jail time. It's a very powerful reason for them to actually care about that tone at the top we talked about earlier.
And SOX also beefed up auditor independence, right?
It did. It codified that external auditors must report directly to that independent audit committee. And, maybe most importantly, auditors now have to give an independent opinion not just on the numbers, but specifically on the effectiveness of the company's internal controls. If the controls are weak, that has to be disclosed to the public.
So when you take a step back and look at the whole picture, from the ethical culture all the way to the threat of prison, what you really have is a comprehensive system built to deter fraud.
That's the goal. You have multiple forces working at once. You have the company's own internal controls. You have the verification from external audits. You have the fear of market punishment.
The stock price tanking.
Exactly. And finally, the threat of severe legal enforcement with personal consequences, thanks to laws like SOX.
Well, that brings us to the end of our deep dive into the architecture of financial integrity. We've gone from the tone at the top, through the 5 specific procedures like segregation of duties and that mandatory vacation rule, all the way to the external backstop of SOX. This whole framework is what gives us that critical but never absolute reasonable assurance. For you, I think the key takeaways are really understanding that difference between preventative controls, things like segregation of duties, authorization, physical safeguards, and the detective controls, like the paper trail and those independent checks. The system is designed both to stop bad things from happening and to make sure they're found if they do.
And while this whole layered system is designed to protect investors, creditors, everyone, the sources are very clear. No system provides absolute protection. These controls all rely on people, which, given the extreme consequences we just talked about in SOX personal ruin, jail time, it raises a really interesting question for you to think about. What inherent human factors or what kind of organizational pressures could possibly be so strong that they would lead someone to compromise even this kind of layered defense, knowing full well that the personal price for getting caught is so incredibly high?
A fascinating problem to mull over. Thank you for joining us for this deep dive into the hidden rules that keep the financial world running. We hope this knowledge helps you navigate the markets with a little more insight.